As we look at the board right now, the stock market is officially closed and the closing price for SoFi Technologies stands at exactly $18.19, recorded at the end of the trading session on Monday, June 29, 2026. Over the course of that final session, the equity experienced an intraday rise of 1.9%, moving up 34 cents from its previous close, with a trading volume hovering around 76.8 million shares. While a simple look at the daily green candle might lead many casual observers to believe that this digital banking player is just experiencing another standard bump in a cooperative financial market, the reality lurking beneath this price action is far more complex than a typical upward swing. The hidden engine behind this recent movement isn't just retail enthusiasm or typical options volume, but a strategic shift in institutional capital allocations that has begun quietly reshaping how the market prices consumer finance platforms. Mainstream financial commentators have spent months insisting that mid-sized digital banking equities are trapped underneath a rigid ceiling due to persistent regulatory scrutiny and changing macro conditions. However, the latest tape tells a completely different story, as large-scale fund flows are beginning to treat this asset not as a fragile speculative vehicle, but as an increasingly stable compounder that is forcing its way toward institutional respectability. The common consensus surrounding this equity usually frames it as a hyper-volatile trading instrument, a stock that spikes violently on earnings and then slowly bleeds those gains back into the market over the subsequent weeks. Retail traders often compare its price swings to the rapid movements seen in high-profile technology names like Tesla stock or Apple stock, expecting a bumpy ride but hoping for a sudden breakout. When people log into their accounts on popular investing sites looking for online investment opportunities or seeking customized investment help, they frequently view this brand as a flashy digital alternative to traditional finance, rather than a fundamentally sound institution. The general narrative is that while the app is great for younger consumers, the business model itself remains vulnerable to economic downturns and credit cycles that could wipe out profitability. But if you challenge that standard assumption and look past the superficial headlines, you discover a contrarian reality that forces serious market participants to completely rethink their positions. The true picture reveals a company that is systematically outgrowing its fintech origin story and hardening into a high-margin financial powerhouse, capturing market share directly from legacy institutions that have been too slow to adapt their digital offerings. Recent trading sessions have provided a clear demonstration of this developing friction between market perception and structural reality. Throughout June, the equity has been subjected to dramatic intraday swings, hitting a monthly low near $15.65 before aggressively bouncing back toward its current level near $18. This intense volatility has driven average daily trading volumes well past 79 million shares, confirming that institutional accumulation is actively underway. When you trace where the volume is flowing across different online investing platforms, it becomes evident that large blocks of shares are being accumulated during periods of minor pullbacks. Unlike the chaotic retail rallies of previous years, the current upward pressure is characterized by calculated buy orders that absorb downside volatility. This institutional interest is also spilling over into broader asset classes, where financial products like Fidelity ETFs and other diversified vehicles are adjusting their weightings to account for the company's expanding footprint. The massive volume surges seen during specific trading windows suggest that professional portfolio managers are no longer viewing this stock as an unstable option, but rather as a necessary component of a modern financial services allocation. To fully grasp why the current price action is surprising the broader market, you have to look at how modern investors manage their capital through an individual brokerage account or automated platforms like Schwab Intelligent Portfolios. For a long time, the traditional advisory models and automated services pushed capital exclusively into massive blue-chip financial firms. However, as self-investing has gained massive popularity, the demand for sophisticated financial applications has fundamentally shifted consumer behavior. Users who started out looking for simple Robinhood fractional shares or a clean Robinhood app interface are now maturing financially, demanding comprehensive services that include robust checking accounts, high-yield savings, personal loans, and advanced investment tools. This is where the core strength of the business model reveals itself. By offering a comprehensive financial ecosystem through the SoFi trading platform, the firm manages to cross-sell multiple services to a single user at a fraction of the customer acquisition cost faced by traditional brick-and-mortar operations. This organic synergy allows the firm to generate continuous fee income and stable net interest margins even when traditional lending markets face temporary headwinds from shifting central bank policies. This structural advantage becomes even more apparent when you compare it to the competitive landscape of online investing sites and legacy brokerages. Platforms like Interactive Brokers Trading and the standard Interactive Brokers platform have long served advanced active traders by focusing heavily on lowering Interactive Brokers fees and optimization. Meanwhile, massive incumbents like Fidelity Investments and the widely used Fidelity mobile app have dominated the mainstream wealth management spaces with traditional Fidelity mutual funds and Fidelity IRAs. In the middle of this landscape, the SoFi active investing ecosystem has successfully carved out an incredibly lucrative niche. It combines the approachable, gamified appeal that made Robinhood stock trading so popular with the comprehensive banking stability that consumers expect from a firm like Fidelity Brokerage. By positioning itself as a one-stop destination for a user's entire financial life, the company has insulated itself from the high churn rates that typically plague single-purpose fintech apps. When an investor opens a SoFi Invest account, they are not just looking to trade a few SoFi stocks or buy some thematic SoFi ETFs. They are often moving their direct deposits, setting up an automated SoFi robo-advisor plan, and using the platform's cash management features as their primary checking account. This deep consumer integration is directly driving the positive financial metrics that are beginning to force institutional recalculations. The company's recent earnings reports have consistently shown an expansion in non-lending revenue streams, a development that is critical for a business that many analysts mistakenly assumed was entirely dependent on student loan refinancing. The technology platform segment, driven by Galileo and Technisys, operates essentially as an independent infrastructure layer for the global financial ecosystem, powering card issuance and payment processing for other institutions worldwide. This business-to-business enterprise model generates predictable, recurring software-as-a-service revenues that carry exceptionally high gross margins. When macro pressures squeeze the consumer lending division, this enterprise technology arm acts as a financial counterweight, stabilizing total net revenues. It is this specific diversification that separates the firm from standard credit providers and elevates it to a position where it can compete effectively against deep-pocketed tech giants and elite trading platforms like the Interactive Brokers stock trading system. Let us look back for a moment at how this business was originally built to understand the distance it has covered. The organization began as a niche student loan refinancing operation designed to help graduates manage their debt burden. Over time, management recognized that acquiring high-earning young professionals early in their career trajectory provided a unique opportunity to capture their lifetime financial value. They systematically expanded their product catalog, acquiring a full national banking charter that allowed them to accept consumer deposits directly. This charter altered the entire economic equation of the company, reducing its reliance on expensive warehouse lines of credit and replacing them with a cheap, stable base of sticky consumer deposits. Instead of paying high market rates to borrow liquidity to fund their loan originations, they could use the deposits sitting in their users' high-yield savings accounts, drastically widening their net interest margins. This historical transformation from a simple marketplace lender to a fully regulated digital bank is the foundation upon which the current financial stability is built, transforming the enterprise from an unprofitable growth story into a consistently profitable enterprise that reported positive net income over consecutive quarters. If you look at how people manage their assets today across the entire landscape of financial services, from setting up an intelligent portfolio to executing active trades on an interactive broker's account, the demand for convenience is the ultimate differentiator. Traditional banking institutions are burdened with thousands of physical branches, legacy mainframes, and massive overhead costs that force them to charge higher fees and offer lower interest rates to their clients. Because this digital banking model completely bypasses those physical constraints, it can pass the cost savings directly to the consumer in the form of superior yields and fee-free accounts. This value proposition creates a powerful word-of-mouth growth loop that reduces reliance on aggressive marketing spend. As institutional analysts analyze these underlying metrics, they are recognizing that the traditional financial models used to value legacy banks are completely inadequate for evaluating a capital-light, technologically advanced platform that scales exponentially without needing to build physical infrastructure. The current market dynamic is further electrified by the broader sector momentum and the performance of high-visibility mega-cap stocks. When investors